Hey everyone, it is me again, talking about money mistakes and maybe a little bit of redemption. I remember being in my early 20s, filled with dreams and an eagerness to get rich quick. I mean, who would not want to, right? The world around me seemed to be full of opportunities, flashy success stories, and people talking about making fortunes overnight. I was hooked. I was naive. I was completely unprepared for what was coming. I was just a regular guy, no fancy background, just trying to make my way. Like many of you watching, my family was not rich, so I always felt this pressure, this deep desire to change my financial situation, not just for me, but for my future, for my family. That desire, that longing for quick wealth became my biggest weakness. It led me down a path of bad decisions, and honestly, a lot of pain. Looking back, the signs were there: high returns, guaranteed profits, all those red flags that seasoned investors warn you about. But I was not seasoned. I was just excited. I saw what others were supposedly making, or at least what they were saying they were making, and I thought, why not me? I jumped in. Head first, without understanding the basics, without doing any real research. I put my hard-earned savings, every single penny I had managed to put aside from my regular job, into things I barely understood. It was short-term speculation, following trends, listening to insider tips from people who, in hindsight, knew even less than I did. I was chasing the next big thing, always buying at the peak, always selling in a panic when things inevitably went south. It was a cycle of hope, followed by fear, followed by loss. My investment journey, if you can even call it that, was a masterclass in how to lose money efficiently. I tried day trading, convinced I could outsmart the market, which is hilarious. Now that I think about it, I fell for scams. Those elaborate schemes that promise the moon and deliver nothing but empty pockets. I took on too much risk, putting all my eggs in one basket, sometimes even borrowing money to chase a dream that was never going to materialize. And emotions. Oh man, emotions were my worst enemy. Every dip felt like the end of the world, every small gain felt like validation that I was a genius. It was a roller coaster, but one where the tracks were always leading downwards. The worst part, the absolute gut-wrenching worst part, was watching all the money I had worked so hard for just vanish. It was not just numbers on a screen. It was my time, my effort, my dreams, all gone. That experience, that complete financial wipeout, was my wake-up call. It was painful, humiliating, but it was also the best thing that ever happened to me. It forced me to stop, to reevaluate everything. I realized that the get-rich-quick mentality was exactly what was keeping me poor. I started reading, studying, not just random articles, but proper financial education. I learned about risk management, asset allocation, diversification, all those boring terms I had previously ignored. I threw away the idea of being an overnight millionaire and embraced the concept of steady, consistent growth. My focus shifted from chasing high returns to preserving capital, from speculation to sensible, low-risk investments. It was a complete paradigm shift. Now, my investing life is completely different. I am not chasing anything. I am not trying to be a hero. I am just a guy who learned his lessons the hard way, and now I want to share those lessons with you. I focus on saving consistently, investing in broadly diversified, low-cost funds, and completely ignoring the daily noise of the market. It is boring, but it works. It is not about getting rich quickly. It is about building wealth slowly, sustainably, and securely. My main goal now is to help others, especially those in their 20s, avoid the painful mistakes I made. I want to share my failures, my blood and tears lessons, so you do not have to go through the same thing. I am here to talk about the pitfalls, the red flags, and the fundamental mindset you need to navigate the financial world safely. Today, I want to talk about 3 crucial things I wish someone had told me when I was starting out. Things that would have saved me a lot of grief and a lot of money. These are not secret strategies, just common sense that I completely missed. First, stop chasing quick gains and understand what real investing is. I used to think investing was about finding the next hot stock, the next cryptocurrency that would explode. It was all about the thrill, the excitement of potentially doubling my money in a week. This led me to speculative assets, things I knew nothing about, purely based on hype. I would see a stock go up 20% in a day. FOMO, fear of missing out, would kick in, and I would buy at the absolute worst time. Then, when it inevitably crashed, I would panic sell, locking in my losses. This cycle repeated itself again and again. What I learned the hard way is that real investing is boring. It is about patience. It is about long-term growth, not short-term wins. It is about understanding the fundamentals of what you are investing in, not just the price fluctuations for most of us, especially beginners. The best approach is often simple. Invest in broad market index funds or ETFs. These are diversified by nature, meaning you are investing in hundreds or even thousands of companies at once. This drastically reduces your risk compared to picking individual stocks. It is about buying regularly, consistently, regardless of what the market is doing. This strategy, called dollar cost averaging, smooths out your purchase price over time. It is not glamorous, but it is effective. It is how average people build significant wealth over decades, not days. So my advice: ignore the noise, ignore the hot tips, and focus on steady, consistent, diversified investing. That is how you build a solid foundation. Second, learn to spot investment scams. This one hits particularly close to home for me. I fell for a few. They were not always obvious. Sometimes they came disguised as incredible opportunities presented by people who seemed trustworthy, even friends of friends. I was once approached about an exclusive investment in a new tech startup. The pitch was smooth, the projected returns were astronomical, and there was a sense of urgency that if I did not act fast, I would miss out. I invested a significant portion of my savings, convinced this was my big break. Of course, it turned out to be a complete fraud. The money vanished, and so did the people involved. Looking back, the red flags were everywhere. Unrealistic returns that seemed too good to be true. They always are. Pressure to invest quickly without proper due diligence. Complex explanations that intentionally confused me rather than clarified. A lack of transparent information about the investment itself or the people behind it. These are all classic signs of a scam. Now, before I even consider any investment, I ask myself a few critical questions. Is it regulated? Can I easily verify the claims being made? Is there clear documentation, like a prospectus, that I can understand? Do I fully grasp how the investment generates returns? If the answers are vague, or if I feel pressured, I walk away. It is better to miss out on a potential opportunity, no matter how good it sounds, than to lose everything to a scam. Protect your capital first and foremost. Third, never invest without a clear understanding of risk and your own risk tolerance. This was another huge mistake I made. I treated investing like gambling. I would put money into something because I heard it could make me rich, without considering what would happen if it went wrong. I had no concept of risk assessment, no understanding of how much I could afford to lose. When the market turned and my investments plummeted, I was completely blindsided. The emotional impact was devastating because I had put in more than I could afford to lose. I would sit there staring at my portfolio, feeling sick to my stomach, unable to make rational decisions. Now, I approach risk very differently. Before I invest a single penny, I define my risk tolerance. How much money can I genuinely afford to lose without it impacting my life, or my ability to meet my financial obligations? For most young people, especially those just starting out, your risk tolerance should probably be on the lower side. You are building your foundation. You cannot afford major setbacks. This means prioritizing capital preservation over aggressive growth. It also means understanding that all investments carry some level of risk. There is no such thing as a guaranteed return. Some investments are inherently riskier than others. Stocks are generally riskier than bonds. For example, small-cap stocks are riskier than large-cap stocks. Speculative assets, like certain cryptocurrencies, are highly volatile and carry extreme risk. A good rule of thumb is to only invest in things you truly understand. If you cannot explain how an investment works to a friend, you probably should not be putting your money into it. Diversification, again, plays a crucial role in managing risk. By spreading your investments across different asset classes and geographies, you reduce the impact of any single investment performing poorly. Never put all your eggs in one basket. And finally, have an emergency fund. This is not an investment, it is a safety net. It is 3 to 6 months of living expenses held in an easily accessible, liquid account. This fund protects you from unexpected financial shocks, like job loss or medical emergencies, preventing you from having to sell investments at a loss. These 3 lessons, understanding real investing, spotting scams, and managing risk, were forged in the fire of my own failures. I lost a lot of money, a lot of sleep, and a lot of confidence along the way. But I am here now on the other side, stronger and wiser. I want you to learn from my mistakes, not repeat them. Do not let the allure of quick riches blind you to common sense. Do not let your emotions dictate your financial decisions, and please, please always prioritize learning and understanding before you put your money anywhere. Your 20s are a crucial time to build healthy financial habits and a strong foundation. It is not about chasing the next big thing. It is about building sustainable wealth, one smart decision at a time. I am still learning, still growing, but I am committed to sharing this journey with you. So thank you for watching, and I hope this helps you avoid some of the potholes I stumbled into. See you next time.